Hi again, this is Lori Brown, Managing Broker with Central Metro Realty in Austin, Texas. We're going to be talking about the Third-Party Financing Addendum, Form TXR-1901. But before we get to that form, I want to take a look at the 1 to 4 family residential contract, specifically paragraph 3. We've covered this paragraph before in the 1 to 4 family walkthrough, which I encourage you to take a look at. We recently revised that so that we covered the newly revised contract. But we're going to go over it again here so that I can show you how the third-party financing addendum works in concert with the contract. So let's take a look at 3A. That's the cash portion of the sale. And today we're going to say, look at it two different ways. We're going to say that the buyer has $400,000 in cash and is going to make a purchase of $400,000. And in that case, he would not need a loan. So we would put 0 for the sum of all financing. And the sales price would be the sum of A and B, $400,000. In the event the buyer needs a loan, let's say the buyer has $100,000 in cash that he's going to contribute to this deal. He's going to need a loan of $300,000. So 100 and 300 equal 400,000 for the sales price. Let's look at B a little more closely. Sum of all financing described in the attached, and we have 3 choices. We can check third-party financing addendum, loan assumption addendum, and seller financing addendum. These are all 3 promulgated forms that you have in your form software. You'll want to take a look at each one of those, but most often you'll be using the third-party financing addendum. Now, what does third-party mean? Third-party means not one of the first 2 parties. The first 2 parties being the buyer and the seller. So this just means that a third party is going to be involved in providing the loan. And so in the case of the third-party financing, we're going to check that, and we're going to talk about that form today. Now, let's say that the buyer was going to assume the seller's loan. We would use the loan assumption addendum. This is not often used anymore. We don't see it very often. I think most of the time when banks allow assumptions or when the interest rates are higher and they perceive that the interest rates will be lower in the future or near future, and would then write in an assumption clause or possibility into their loans, because obviously they would want to maintain that note at that rate instead of having a new buyer get a new loan at a lower rate. So that's when you would see that. And then the seller financing addendum would be used when the seller is going to provide the loan to the buyer. So the seller is going to finance it. If you decide, or a buyer decides to go with a seller financing route, I recommend that you get an attorney for that. There are some rules about what sellers need to provide to buyers, and it's just a good idea to involve an attorney anytime you're doing seller financing. So now we're going to move over to the third-party financing addendum. Now we have the third-party financing addendum, and before we get into the form, I want to emphasize the importance of agents understanding, comprehending the content and the use of this form. It's important that you be able to explain this form to your buyers and sellers so that they have the information in order to comply with the requirements of this form. And this will greatly reduce the risk of conflict down the road. This is where, in paragraph 2 specifically, the paragraph that regarding approval of financing, this is where buyers and sellers will often misunderstand and then have conflict over the requirements for the loan approval and what constitutes a reason that the buyer would be able to terminate a contract based on not getting loan approval and receiving back the earnest money. So we want to make sure that we do have a good understanding of this form. The first blank, we're going to put in the street address and city, and this will auto-populate if you're using a form software, or you may need to type it in. You want to make it match the correct street address and city on your 1 to 4 family or whatever contract you're using. And then paragraph 1, type of financing and duty to apply and obtain approval. So this paragraph does two things. The buyer discloses to the seller what type of financing they're going to be seeking, and 2, that specifies that they shall promptly apply for all financing and make every reasonable effort to obtain approval for the financing, including furnishing all the information and documents the lender requires. So number 1, the buyer discloses to the seller which type of loan they're getting, and this is important because each one of these loans has a different set of requirements, different time frames, even different ease or difficulty in obtaining loan approval. So it's important sellers have a good understanding of what the buyer is going to be, what they're going to be required to do to obtain loan approval. And then the second part, the buyer can't drag their feet. They have to promptly apply for financing so that all the deadlines and the closing date can be met. So we're going to check A, conventional financing. And a conventional loan is a third-party loan that is not backed or insured by the federal government. The other 5 loans here are federally backed loans. We're not going to go into all of these, but we may do some videos on some of these at a future date. But basically, you're filling in the loan terms for each one of these loans. So for one, a first mortgage loan and the principal amount of, for our example, we've got $300,000 for the loan amount, excluding any finance PMI premium. Now PMI, what is that? Private mortgage insurance. This is insurance that is charged to the buyer that does not have at least 20% money, cash, into the transaction. And this is to insure against default. Data shows buyers that have less than 20% are at risk of default, and lenders want to make sure that they're covered, so they charge insurance. It says due in full in blank years. You're going to put in the term of the loan. It could be 30 years, 20 years, 15 years, just whatever the lender and buyer have worked out, with interest not to exceed blank percent per annum. So I want to stop here and just say this paragraph is not setting or establishing the terms of this loan. It is establishing the limit of the loan, the upper limit. It's saying if the buyer cannot meet these terms, below or at these terms, they are able to terminate this contract because they don't get loan approval and receive back their earnest money. The buyer wants to put in as low an interest rate here as possible, closest to the market rate. Let's say the market rate here was quoted to them at 3%. I would recommend putting a little bit of a cushion. That way, if by the time the buyer locks his loan, which is after he gets the property under contract, let's say it's gone up a little bit, you don't have to renegotiate this loan. The seller wants this to be higher, just in case something happens. Let's say the buyer had some credit issues and the lender approves the loan, but at a little bit higher interest rate, say 4%. The seller would like to put in 4% here, but this is negotiable. So again, this is an out for the buyer. The buyer is going to want to have it just slightly above the market value, or the market interest rate that he was quoted per annum for the first 30 years. So this is typical. The loan will be amortized over the entire term, and interest rate will be applied per year over the entire life of the loan, with the loan origination charges not to exceed, and I usually put in 1% here. That's pretty typical. Sometimes there won't be an origination charge, but we want to put something here. The seller is going to want to know that if for some reason, again, the lender requires a little bit more, that the buyer will not have an out here. So you could put in 1%. You could even put in 2%, just in case. Let's say the lender came back and said, no, we want to do it for 1.5% because your interest rate's a little bit low. We want a little bit more up front. in the origination charges. So we could put a cushion in here of 2. And then number 2 box here is for a second mortgage loan. Why would you need a second mortgage loan? Well, a buyer that doesn't want to pay private mortgage insurance sometimes can take out a second loan. Usually it's a home equity loan, and it's at a little higher interest rate or has a variable interest rate, and then the lender will waive the PMI, the private mortgage insurance, and this will include having not two closings, but 2 closing costs for both of these loans. So know that, but that's something that you can discuss with the lender or with your buyer. That might help the buyer avoid paying that PMI. And but in our case here, we're only going to have 1 mortgage loan. So then we're going to go down here and just take a quick look. We have a Texas Vets loan. These are for veterans in the state of Texas. They don't have to be from Texas. They do have to be a veteran. There's some other requirements, so you want to check that out. We have an FHA insured financing. This is common for buyers who don't have a lot of cash, may not have as high of a credit score as what it might take to get the conventional financing. And this is common, FHA, a 203B for that buyer that may just need a little bit of extra assistance. They will usually have a little bit higher interest rate to get this FHA loan. It does include mortgage insurance. They call it MIP in the case of an FHA loan, but it's the same thing. The loan is insured because the buyer does not have a great deal of equity in the loan to start off with. And then you'll complete these terms just as you did up here in the conventional financing. We also have a VA guaranteed financing. So again, for vets, and this is maybe the topic of another video on loan eligibility. And then we have USDA guaranteed financing. This is for rural loans. This is not given everywhere. For example, in the state of Texas, it will be in rural areas where the U.S. Department of Agriculture are encouraging growth in rural areas. So that's something you may want to have your buyer check out. And then reverse mortgage financing. This is usually is for seniors 62 and over. And it's another video topic that possibly we'll get into later. If you've got a senior buyer and they need to tap into home equity, have them check out the reverse mortgage financing. And then 2, approval of financing. Now this is the paragraph that causes the most conflict or potential conflict because it discusses how the buyer can terminate on what terms. So approval for the financing described above will be deemed to have been obtained when the buyer approval and property approval are obtained. This is important to note. There are 2 aspects of financing approval. There's buyer approval and property approval. They are not the same thing. Buyer approval has to do with the buyer's ability to pay. And the property approval has to do with the insurability and value of the property. Notice here in bold, time is of the essence for this paragraph, and strict compliance with the time for performance is required. So the deadlines are strict here. If you do not comply within the time frame, the buyer will have no out. So pay very close attention to your deadlines and help your clients keep track of the deadlines. 2A, buyer approval. You're going to check one of these 2 boxes. Either the contract is contingent upon loan approval for the buyer or it is not. This contract is subject to buyer obtaining buyer approval. If buyer cannot obtain buyer approval, buyer may give written notice to seller within blank days after the effective date of this contract, and this contract will terminate and earnest money will go to the buyer. What should go in this blank? Well, typically, I put in 21 days, about 3 weeks, to get loan approval, where the buyer gets everything over to the lender and the lender has time to process and then approve or disapprove the buyer. But in today's market, some sellers are going to want to shorten this. It's very important that you talk to the lender up front before you go under contract, before you write an offer, and find out what does the lender need for loan approval. The shorter the better. Even more important for the buyer to get in there early and get the loan process going so that you can keep this as short as possible so that you can win a contract. And then here, this contract is not subject to buyer obtaining buyer approval. Now, why would you want to check this? Well, I would use this if the buyer were attempting to get a loan but wants to tell the seller, if I don't get the loan, it's okay, I'm going to proceed with this, I've got the cash to cover it. So this is, I heard one realtor say that you would check this if you knew you had loan approval. In my opinion, it's impossible to know with certainty that you have loan approval. So I would only check this if I knew the buyer had the funds to cover the purchase in the event he doesn't get loan approval. And then B, property approval. This is basically related to the appraisal. If the buyer's lender determines that the property does not satisfy the lender's underwriting requirements for the loan, including but not limited to appraisal, which is the estimate of value that the appraiser is going to provide, insurability, and lender required repairs. So insurability has to do with whether or not the property meets the physical conditions that renders it insurable. So for example, let's say the appraiser went there and the roof was leaking, it was very old and it needed to be replaced. He's going to report that. The lender may not lend on that, or they may require repairs. And if that could not be negotiated with the seller, the buyer would then have an out and they would be able to terminate based on not getting property approval. Note here, the buyer has to be notified of the disapproval not later than 3 days before the closing date. May terminate this contract by giving the seller notice of termination and a copy of a written statement from the lender disapproving the loan. If buyer terminates under this paragraph, the earnest money will be refunded. And then note the next line. If a buyer does not terminate under this paragraph, property approval is deemed to have been obtained. So if you do not meet the deadlines and the written requirements here, then a court of law would see that the property and buyer were approved and could enforce specific performance if it went that far. So it's very important that you as an agent keep track of deadlines. Make sure you comply. If your buyer does not get approved, you've got to provide written notice within the time frame you've put in the contract, along with a letter from the lender. Very important. And then 3, paragraph 3, security. This just specifies that each note for the financing described has to have a vendor's lien and a deed of trust. And this is how we do it in Texas. We're title theory. We won't get into that today, maybe another video, but it will require that the note be secured by a vendor's lien and a deed of trust. And then 4, FHA, VA required provision. So here, if it's an FHA or VA, this blank, FHA and VA are going to want to put they're going to want to see the appraised value come in at the contract price. So that you're going to put the contract price in here. So I'm going to put in $400,000. Let's read this together. If the financing described above involves FHA insured or VA financing, it is expressly agreed that, notwithstanding any other provision of this contract, the buyer shall not be obligated to complete the purchase. So they're not going to require the buyer to purchase this if it does not appraise for the sales price. And then, if the contract purchase price or cost exceeds the reasonable value of the property established, the 3-day notice of termination requirements in 2B does not apply to this paragraph 4. So up here, you had the lender had to give notice, and the buyer has to let the seller know not later than 3 days before the closing date that the property did not appraise. But here, there is no 3-day requirement. They can terminate the last day. So the day before closing, if the appraisal came in, it did not appraise, the buyer could get out. Here in A, it says the buyer shall have the privilege and option of proceeding with consummation. So for VA and FHA, the buyer can put up the difference. So let's say the appraisal came back at $380,000, there's a $20,000 difference. The buyer can proceed, and if they've got $20,000, as long as, for example, VA has certain terms that the buyer has to meet there, it can't be from certain funds, it has to be approved, the buyer can make up the difference. And then 5, authorization to release information. A, buyer authorizes buyer's lender to furnish to seller or buyer or their representatives information relating to the status of the approval for the financing. And then seller and buyer authorize buyer's lender, title company, and escrow agent to disclose and furnish a copy of the closing disclosures and settlement statements provided to the parties' respective brokers and sales agents. So this is giving permission for the lender to share information about the loan to the parties involved. Notice it says status and not details, though. It's not specific details, personal details about the buyer, but they can report on the status of approval, and then they can give a copy of the closing disclosure and the settlement statement to the brokers and the sales agents. So that's important to note. So this is the third-party financing. One more thing I want to say about using the third-party financing. I'm of the opinion we have the appraisal waiver form that you should be using the appraisal waiver always with this third-party financing. And let me explain why. Because it's possible for the lender to approve the buyer here. So in our example, I'm going to go back and try to explain this where you can understand it. It can be a little bit complicated, but in our example, the buyer is putting up 25% for his down payment. So he's putting up $100,000 on a $400,000 property. But let's say, so he's putting down more than 20%. So let's say that the lender, after the appraisal, and the appraisal comes back low, let's say the lender says, well, I'll still loan you the money. You're putting down, good 25%, so I'm comfortable lending you the money. But let's say the buyer did not want to proceed if it did not appraise for the $400,000. So we can have that happen. And the only way for the buyer to be able to back out of this contract if it does not appraise would be to use that appraisal waiver form. So this form alone will not protect the buyer in the event there is a low appraisal. So take a look at the appraisal waiver form that we have on our website. And then if you have further questions on how that works, reach out to me at the phone number and email that you see there. And as always, I really enjoy doing these videos for you and welcome your questions and comments. And I hope you're having a great day, and I'll see you soon.